Index funds or ETFs, which one's superior? If you've ever Googled how to start investing, you've probably seen both thrown around as the wise choice for beginners. But here's the point. While they appear almost identical, there's some minor differences that can make a huge difference in the long term. So today, we're breaking down what they are, their similarities and distinctions, and ultimately, which one might actually be the better fit for you. Welcome to Money Explorer, where we explain investment concepts in a straightforward way. But first of all, a quick disclaimer. This is not financial guidance. Okay, so let's break down index funds. What is an index fund? Imagine you want to invest in the stock market, but you don't know which companies to select. Should you purchase Apple, maybe Tesla, or play it safe with Coca-Cola? The issue is nobody truly knows which single stock will perform the best. That's where index funds come in. An index fund is like a large basket that contains a collection of different stocks, usually designed to mirror a particular index. For example, an S&P 500 index fund owns shares of all 500 of the largest U.S. companies from Apple and Microsoft to McDonald's and Walmart. So, when you purchase one share of that index fund, you instantly obtain a little portion of all those companies. You don't have to worry about predicting. If the overall market rises, your investment rises with it. And because index funds don't have costly managers attempting to outperform the market, they're merely copying it. The charges are extremely low compared to traditional mutual funds. Most index funds charge an annual fee called an expense ratio of anywhere from 0.02% to 0.20%. That implies if you invest $1,000, you might pay just 20 pence to $2 per year in fees. This is because they are passively managed. Index funds differences. One key thing to note, index funds are priced only once a day. At the end of each trading day, the fund calculates something called its NAV, net asset value, which is essentially the average value of all the stocks inside it. No matter when you place your order, you'll get that end-of-day price. Another interesting advantage of index funds is how they're treated in some countries when it comes to taxes. For example, in certain places, you can shift from one index fund to another, say, from an S&P 500 fund to an international stocks fund without triggering a taxable event. That means you don't have to immediately pay capital gains taxes just because you reallocated your investments. Of course, this relies heavily on the tax regulations where you reside, but it's one of the reasons index funds are often utilized in retirement accounts and long-term portfolios. For example, in the U.S., selling one index fund to move your money into another is considered a taxable event. So, you likely owe capital gains taxes, meaning this isn't really an additional benefit. However, in countries like Spain, some laws permit you to switch between funds without triggering immediate taxes, enabling your investments to grow tax-deferred until you eventually withdraw. Let me know what's your perspective on this. Index funds are offered by major fund providers like Vanguard, Fidelity, or BlackRock. Each management company has its own rules on how and when your order is executed. But generally, all index fund trades are processed once per day at the fund's closing price. What is an ETF? Now that we've covered index funds, let's talk about ETFs or exchange-traded funds. On the surface, they can appear very similar. You can get exposure to hundreds of stocks or bonds in one single investment, just like an index fund. For example, an S&P 500 ETF holds shares of all 500 big U.S. companies. So, you're instantly diversified across the market. But here's where ETFs stand out. ETFs differences. They trade on stock exchanges just like ordinary shares. That means you can purchase or sell them anytime during market hours, and the price shifts throughout the day based on supply and demand. Compare that to index funds, which only get priced once a day at their net asset value. And you can see how ETFs provide investors more adaptability and control over when they enter or leave a position. ETFs are also comparatively new compared to index funds. The very first one in the US, the SPDR, with ticker symbol SPY, was launched in 1993, and it's still one of the largest in the world. Since then, ETFs have skyrocketed in popularity, not just in the US, but internationally, because they merge diversification with the convenience of some flexibility. And here's another twist. While most ETFs are passively managed, meaning they simply follow an index like the S&P or the NASDAQ. There are also actively managed ETFs. Actively managed ETFs. These are funds where professional managers try to surpass the market by hand-picking investments. Some investors prefer to invest in them because they allow you to speculate on specific ideas or sectors. Example of ETF fact sheet. To make this practical, let's pull up a fact sheet for a popular ETF, the VOO, the Vanguard S&P 500 ETF. It should clearly state it follows the S&P 500, so that is passively managed. Another detail is the number of holdings and the method. You might see terms like full replication, which means the ETF owns almost all the stocks in the index. That's a sign you're genuinely getting the whole market basket. Next is the expense ratio. As we can observe, it's only about 0.03%. That's one of the cheapest funds you'll ever discover. Another thing to check is dividends. VOO, for instance, distributes dividends, which means it pays out cash to investors, typically every quarter. Some ETFs function a little differently. These are called accumulating ETFs. Instead of paying you dividends, they automatically reinvest them back into the fund. Then we got the top holdings and their weights. Here you'll usually see familiar names: Apple, Microsoft, or Amazon. Remember, these alter slightly as the market moves since the holdings are ranked by market capitalization, meaning the biggest companies in the market naturally take up the largest portion of the fund. Common misconceptions. Now, before we wrap up, let's clarify some widespread misunderstandings about index funds and ETFs. First, just because something is an ETF doesn't instantly make it superior to an index fund. Yes, ETFs trade like stocks, but that flexibility isn't always practical, particularly if you're a long-term investor. Second, actively managed ETFs don't assure higher returns. Selecting a manager who consistently outperforms the market is extremely tough. According to Morningstar, only about 3 out of 10 active funds actually beat the market over the long run. And finally, many people assume ETFs are risk-free just because they're diversified. But here's the reality. An ETF is only as secure as what's inside it. If it's following something volatile like tech or crypto, it can fluctuate just as much as individual stocks. I would say that choosing between index funds or ETFs really depends on the country you live in and your method of investing. However, the key is to remain in the market with low fees and concentrate on long-term growth. If you found this video useful, please consider subscribing and smashing the like button to continue expanding this community. And if you enjoyed this video, you'll probably enjoy this one as well. Thanks for watching, and I'll see you very soon.